value trades, forex, CFDs, and commodities. In 13th century Italy, a mathematician called Leonardo Fibonacci discovered that many elements in our daily lives follow a predictable sequence. Traders use the same numbers to plot sequential levels of support and resistance following reversals from previous trends. Before we look at Fibonacci, we would like to remind you that CFDs and Forex are leveraged products and your capital is at risk. These products may not be suitable for all investors, and we encourage you to read the risk warning on the Value Trades website. The use of Fibonacci can be quite simple or quite complex and can be used for spotting support and resistance levels or used to confirm stop loss and take profit positions. Before we start, we need to identify a trend from beginning to end. For example, here on this Aussie Yen 30-minute chart, we can see a swing low here and a swing high here, identifying a large bear run. Click on the Fibonacci button on your MT4 toolbar and click, drag, and drop a line between the 2 points. If you see what I see here, lines and figures in yellow, as is the MT4 default, and conflicting with your chart background color, simply right-click on the chart, select Objects List, select Fibo, and Edit. You may now change the color to something more suited to your chart background. So, using Fibonacci sequencing, it was established that key levels of retracement occur at 23.6%, 38.2%, 50%, 61.8%, 100% of course, and should price break through, Fibonacci extensions would occur at 161.8%, 261.8%, and 423.6%. Okay, we have charted a bear run, and using the guidelines for the Fibonacci retracement, we see that price did in fact return and bounce off the 50% level and again off the 61.8% level. It also used the 38.2% level as a level of support. If we extend these lines, we can look back and see that these levels of support and resistance repeated themselves in previous price action, with this support at 23.6% and these clear zones of supply and demand at the 50% area. Traders may use these levels and trade them as normal support and resistance, and of course, it is always a good idea to look for confirmation with other indicators. For example, using stochastics, we can see where overbought became oversold and vice versa from these bounces off Fibonacci levels. This sharp move to the upside hit resistance at the 61.8% level and could not break through. So, entering on this confirmation, placing a stop loss at or around this Fibonacci level, and placing a take profit at either Fibonacci support level would have been a good trade. If we look at this 1-hour chart on pound-dollar, we can plot the Fibonacci levels off this big move to the upside, and we can clearly see that, if we scroll forward, these levels of support and resistance are repeated many times. This includes acting as a neckline for this double top, which closed exactly at the 23.6% Fibonacci level. Another clear example is this hourly chart on gold. Price found support at 23.6%, then again at 38.2%. This line of support became the next line of resistance as price ranged between 61.8% and 38.2%. If we change time frames, we can see that the Fibonacci levels followed us to this 4-hour chart where, with patience, had we used stochastics, we can spot some nice entry and exit points. That's all for now. Happy trading with Value Trades, and we will be back with more soon.